Hey guys, today I want to talk to you about a few popular investment vehicles that you should be aware of in order to become a well-informed investor. These are stocks, index funds, and mutual funds. Generally, publicly traded companies aren't owned all by one person. This is because they're often worth millions, billions, or even trillions of dollars. As a result, these companies are split up into what are called shares, and a share is a certain percentage of the overall value or market capitalization of a company. So when you buy a share of stock in a company such as Nike, you actually become a part owner of Nike. As an owner, you expect two types of financial returns. Those are capital gains, and that's when the value of Nike as a whole goes up, and dividends, which are small amounts of cash that are paid out to investors, generally quarterly. A quick glance at a Google Finance stock chart can tell us some important information about a company. Here we can see that at the end of the day today, Nike's stock price closed at $87.28, a gain of 58 cents on the day and over a half a percentage point in total. Looking at the chart, we can see Nike's year-to-date performance, which means their performance since January 1st. On that date, Nike's stock price was just over $70, and recently it grew to almost $90. Looking down below at some of the numbers, we can see on the top right that the market capitalization of Nike is $109.26 billion. This is why Nike currently has over 1 billion shares of stock outstanding. The next investment vehicle that we want to talk about is an index fund. An index fund is a collection of stocks that replicates the performance of a specific index. So, for example, you may have heard of the S&P 500 index. The S&P 500 is a collection of the 500 largest companies in the United States. So, when you invest in an S&P 500 index fund, you're buying a share of a fund that contains stock from the 500 largest companies in the United States. Here's a chart for the S&P 500 index that is very similar to the Nike stock chart that we looked at previously. As you can see, the value of the S&P 500 index has grown significantly since the beginning of the year. On January 1st, the value of the index was about $2,500, and today it closed at $3,003.67. Despite these gains, you can see in the red numbers that are next to the current price that today the value of the index fell $15.89, or just over 0.5%. You would expect that an S&P 500 index fund would replicate this performance and have also fallen in value today. The last investment vehicle that we are going to discuss today is a mutual fund. A mutual fund is very similar to an index fund in that it is a collection of stocks within a fund that you can invest in. The main difference between a mutual fund and an index fund is that while an index fund attempts to replicate the performance of a specific index, a mutual fund attempts to outperform that index. So in the case of an S&P 500 index fund, it contains the 500 largest companies within the United States, whereas an S&P 500 mutual fund may only contain 200 or 300 of those largest companies. And this is done through active management, where managers go in and actively decide which companies should or should not be included in their mutual fund based on how they expect those companies to perform for the coming year. While this may seem like a good idea to include in your portfolio, it can actually be very difficult for managers to outperform a specific index like the S&P 500 year over year. While many can do it once or twice, it is very rare that they can do it consistently over 5, 10, 20, or 30 years. What's more is that these managers charge fees on these mutual funds that are significantly higher than index funds. So oftentimes, you can be charged more for a worse performance. That is why I recommend starting out by including index funds in your portfolio. If you have any questions, as always, shoot me a DM or comment on this video, and I'd be happy to answer them or address them in a future video. Thanks.